Welcome. We're diving deep into Carnival Corporation's Q3 2025 earnings and their outlook. We'll get you the strategic shortcut.
Exactly. We're here to pull out those key financial nuggets and the strategic insights for you. Let's get straight into the Q3 results.
And the headlines are massive. I mean, an all-time high net income, $1.9 billion. Adjusted, it's even higher, $2.0 billion.
Yeah, that officially beats the previous record from back in 2019.
A huge benchmark surpassed.
It really is stellar performance. Record revenues, too, $8.2 billion. That's, believe it or not, the 10th straight quarter of record revenue for them.
Wow, 10th quarter.
And the adjusted earnings per share, the EPS, came in at $1.43. That just smashed the forecast of $1.32. Shows real momentum.
Okay, so that momentum clearly fed into their guidance, right? They've raised expectations again.
So the third time this year, yeah. They've upped the full year 2025 adjusted net income guidance.
And what's the new number looking like?
It's expected to be up nearly 55% compared to last year, so around $2.9 billion. And if you look at adjusted EBITDA, kind of their cash flow measure, that's now forecast around $7.05 billion. That's a solid 15% jump over the 2024 projection. Basically, the strong Q3 gave them a lot more confidence for the full year.
That is just massive outperformance.
Yeah.
So what's really driving this? I mean, how did they beat their own June guidance so significantly?
It really comes down to a few core things: yield, efficiency, and getting better returns from the ships they already have.
Okay, break that down. Let's start with yield.
Right. So net yields, that's basically revenue per passenger spot, hit an all-time high. They were up 4.6% year over year.
And that's stripping out currency effects.
Exactly. That 4.6% is in constant currency. So it shows genuine pricing power, not just, favorable exchange rates.
But wait, the sources mentioned they actually had less capacity, right?
Yeah.
About 2.5% less than Q3 last year.
That's the really impressive part.
How do you do that? Raise yields with fewer cabins.
That's the key success story here. That entire 4.6% yield increase. It was achieved purely on a same-ship basis. They literally made more money per available cabin per day.
The strong demand.
Very strong, close-in demand, people booking nearer the sailing date at higher prices, plus people continuing to spend a lot once they're on board.
Incredible pricing power then. But okay, what about costs? I saw adjusted cruise costs, excluding fuel per ALBD, were up 5.5%. That's, well, kind of high.
Yeah, 5.5% seems like a jump, but you need the context. First, ALBD is just available lower berth day, the industry standard for measuring cost or revenue per passenger spot.
Right, like RevPL for hotels.
Exactly. And while 5.5% is the number, the key thing is their cost discipline. That result was actually 1.5 percentage points better than the guidance they gave in June.
Ah, okay. So they controlled costs better than even they expected.
Precisely. They're managing costs effectively. And don't forget, fuel efficiency, fuel use per ALBD was down over 5% year over year, too.
Okay, better than expected costs, great fuel efficiency. And there was another big milestone, wasn't there? Something about profitability.
Yes, a huge one. Adjusted return on invested capital, ROIC, hit 13%. That's the first time they've reached that level in almost 20 years. Since 2007, actually.
20 years. Wow. So what does 13% ROIC really signify for someone listening? Why is that such a big deal?
It means for every dollar they've invested in their ships, their terminals, everything, they're now generating 13 cents in operating profit. It fundamentally validates their whole strategy.
It shows the existing assets are really working hard for them.
Exactly. It signals a major turnaround in how effectively they're using what they have. It's not just good, it's arguably transformational for their operational story.
Okay, so the present looks strong, validated by that ROIC. Let's shift to the future. How's the booking situation looking? How far out can they see?
Visibility is pretty deep, actually. They're looking well into 2026 now.
And the booking levels?
For 2026, they're already nearly 50% booked. That's basically in line with the record pace they saw for 2025 at the same point last year.
Okay, same volume pace, but what about price?
That's the kicker. They're getting those 2026 bookings at historical high prices, again, in constant currency, and that strength is broad across both North America and Europe.
High volume and high prices. And I guess that's supported by all the cash they're holding from customer deposits.
Absolutely. Customer deposits hit another record in Q3, $7.1 billion. That's up over $300 million from last year. It's essentially cash on hand for future sailings.
And they even mentioned 2027.
Yeah, they said bookings for 2027 are off to an unprecedented start. They saw record booking volumes for 27 coming in during this past quarter, Q3 25.
That forward strength is really interesting, especially because they're not planning to add many new ships soon, are they?
That's a really key strategic point. Capacity growth for 2026 is minimal, like forecast at just 0.8%.
So growth isn't coming from just adding more berths.
Nope. Future revenue growth, margin growth, it has to come from improving yields on the existing fleet. They need to keep pushing that pricing power on the ships they already sail.
And part of driving that yield is investing in destinations, right? As I mentioned of Celebration Key.
Exactly. Celebration Key, their new private destination, just opened in July. They're expecting almost 3 million guests to visit just that one spot in 2026. Plus, they're expanding the pier at Half Moon Cay. That's due mid-2026. The big picture. They want over 8 million guests visiting their 7 exclusive Caribbean spots next year. Leverage the footprint.
Makes sense. But looking ahead always involves potential bumps. What are the headwinds we need to watch for in 2026?
Yeah, there are a couple of specific things they called out. First, the new Carnival Rewards loyalty program kicks off mid-year.
Okay.
They expect that to be about a 0.5 percentage point drag on yields in the second half of 26 as those customer benefits start hitting the books.
All right, a loyalty program impact. What else?
Increased dry dock expenses. They're spending more next year, partly on upgrading some older ships. That could add maybe up to 1 percentage point to their unit cost increase.
Okay, so loyalty and dry docks are the main watch items for 26 costs and yields. Now, all this relies on their financial foundation. The balance sheet took a huge hit during the pandemic. How's that financial fortress looking now?
Oh, the improvement there is dramatic. It's really setting the stage for their next chapter. Net debt to adjusted EBITDA, the key leverage ratio. It's down from 4.7 times just a year ago in Q3 2024 to 3.6 times now in Q3 2025. That's a massive shift.
3.6x. That's getting pretty close to their target, isn't it?
It really is. They're zeroing in on their near-term goal of getting back to investment-grade metrics. Long-term, they want to be under a 3.0x net debt to EBITDA.
And how did they manage such a quick improvement?
A lot of active debt management. They refinanced over $11 billion in debt this year alone.
Oh.
And just this quarter, they cut their secured debt by nearly $2.5 billion. It simplifies things, lowers interest costs.
Right. And that rapid improvement in financial health allows them to finally make the big pivot.
Back to shareholders. Exactly. The strong results, the lower debt, it all positions them to start returning capital.
And they announced the first step.
Yes. They gave notice they're redeeming all their outstanding convertible notes. They'll use a mix of cash and stock for that. The net effect is about a $600 million improvement in net debt, plus it means fewer shares outstanding for calculating 2026 EPS.
Good for earnings per share. And what's the number one priority for returning capital going forward?
Reinstating the dividend, that's the clear focus. They've basically signaled that getting leverage down to where it's projected to be in early 2026 hits their target for comfortably bringing back the dividend. Consistent dividends first, then maybe buybacks later.
Okay, so stepping back, the big picture seems clear. Record results driven by smart yield management on the current fleet, really strong forward bookings at great prices, and this huge financial turnaround enabling shareholder returns.
That sums up the financials perfectly. But let me leave you with one more strategic thought, something from the source materials about how they see the world.
Okay.
Carnival doesn't primarily see its competition as, say, Royal Caribbean or Norwegian. They view their main competition as land-based vacations.
So like trips to Orlando, European city breaks, beach resorts, that kind of thing.
Exactly. And they explicitly stated they believe the value gap, the difference in cost and experience between a cruise and those land options, is still enormous.
Meaning they think cruises are still a much better deal.
That's their perspective. And if they genuinely believe that value gap is still enormous, well, you should probably expect their pricing and marketing to keep pushing that angle. It suggests they feel they still have room to raise prices further before hitting resistance compared to land alternatives.
That's a fascinating way to frame their future strategy and pricing power. A really insightful deep dive today.